Welcome to your ultimate beginner's guide to investing. This video is perfect for anyone looking to start their journey in investing, even if you have zero prior knowledge. I'm going to break things down in the simplest way possible. No special knowledge or qualifications are needed. I'll walk you through every step, from the basics to actionable strategies, so by the end, you'll be ready to get started, or at least have a much clearer understanding of the world of investing. The truth is, investing isn't as complicated as many people make it out to be, and you absolutely can do this. Feel free to ask any questions in the comments below. Make sure to hit the like button and subscribe for more valuable content. Ready to dive in? Let's get started. Chapter 1. Why do you need to invest your money? Before you start putting your money anywhere, let's think about why investing is important in the first place. Think of investing like going to the gym. You don't do it just once and expect to be super fit. You do it regularly because it feels good, helps you in the long term, and keeps you healthy. Investing works the same way. It helps protect your money from losing value over time due to inflation. Inflation is like a silent enemy to your money. For example, in the 1970s, a gallon of milk in the US cost about $1.15. Today, it's around $4.50. That's almost 4 times more. This shows how inflation erodes the purchasing power of your money over time. If you kept your cash under the mattress all these years, it would buy a lot less now than it did back then. That's why you need to invest, to make sure your money grows at least as fast as inflation, and hopefully even faster. Investing is also great for your personal finances. It means you're spending less than you earn, which is a good sign of a healthy budget. Plus, it gives you a financial cushion in case of unexpected events. Whether you're investing to buy a house, retire comfortably, or just save for the future, knowing why you're doing it will help keep you motivated. Remember, investing isn't a way to get rich quick. It's a way to grow your wealth steadily over time. Now, let's talk about what kinds of things you can invest in to beat inflation and grow your money. Chapter 2. Overview of investment assets for new investors. When it comes to investing, you might hear lots of opinions about the best investments, but let's start with the basics. Investing means putting your money into assets, things that can increase in value over time. Types of assets. You can invest in stocks. Buying shares in a company like Apple, Tesla, or Google means owning a small piece of that business. If the company does well, the value of your shares goes up, and you can make money. For example, if you bought Apple shares in 2016, they have increased by 500%. Bonds. Bonds are like loans you give to a government or company. In return, they promise to pay you back with interest. It's like being the bank and earning interest on your money. US Treasury bills are a common example. Commodities. These are raw materials like gold, silver, oil, or even coffee. Their value can change based on supply and demand. For example, gold is often seen as a safe investment. Property. Buying real estate, whether it's your home or a rental property, can be a good investment if property values increase over time. Many people invest in property as a way to grow their wealth. Cryptocurrencies. Digital currencies like Bitcoin are a new type of asset. They're risky and highly volatile, which means their value can go up and down a lot in a short time. Be cautious when considering these. Mutual funds and ETFs. These are collections of different assets, like stocks or bonds, that you can buy into, which helps spread out risk. They are managed by professionals and are great for beginners. Key risks to consider. Volatility. Some assets, like stocks or cryptocurrencies, can change in value quickly. They can go up or down, so there's a risk you could lose money. Market uncertainty. No one can predict which assets will perform best in the future. Be wary of anyone claiming to have the secret to getting rich quickly. Risk of loss. Some investments can lose all their value. For example, if a company goes bankrupt, its stock can become worthless. Bottom line, start simple, understand what you are investing in, and be aware of the risks. Remember, there are no guarantees, and it's essential to do your research before putting your money into any investment. Diversify your investments to reduce risk. Don't put all your money in one place. Chapter 3. What are index funds and why are they important? An index fund is a type of investment fund that aims to track the performance of a specific group of stocks known as an index. For example, in the US, the S&P 500 is an index that includes the 500 largest companies, like Apple, Microsoft, Google, Amazon, and Tesla. When you invest in an index fund, your money is spread across all the companies in that index. If you invest in an S&P 500 index fund, you don't have to buy individual shares of all 500 companies. The fund does that for you, proportionally based on each company's size in the market. For example, if Apple is 6.5% of the S&P 500, then 6.5% of your investment in the fund goes into Apple. Why are index funds popular? Low cost. Index funds usually have very low fees because they are not actively managed by a fund manager picking individual stocks. For example, a popular index fund from Vanguard has a fee of only 0.07% per year, meaning you'll pay just 70 cents in fees for every $1,000 invested. Good performance. Historically, index funds have often outperformed many actively managed funds, where managers pick individual stocks. Research shows that over 10 years, around 80% of actively managed funds fail to beat their index fund counterparts. Simplicity. With index funds, you don't need to research individual companies or decide when to buy or sell. You buy the market and benefit as it grows over time. Things to watch out for. Fees and charges. Pay attention to fees, which can reduce your returns over time. Index funds typically have lower fees than actively managed funds. Market risk. Like all investments, index funds can go up or down in value. They are not immune to market declines, but they tend to be less risky than picking individual stocks. Key takeaway. Index funds are a simple, cost-effective way to invest in the stock market. They offer broad diversification, which means spreading your investment across many companies to reduce risk. For most new investors, index funds are a great way to start. Just be mindful of the fees, keep it simple, and focus on the long term. Chapter 4. Choosing what to invest in. When choosing what to invest in, keep in mind that it depends on your personal situation, goals, age, risk tolerance, and other factors. Here are some key points to consider. Diversification. Diversification means spreading your investments across different types of assets to reduce risk. Just like owning multiple smaller houses instead of one big mansion, you spread the risk so that not all of your investments are affected by the same event. In the stock market, this means investing in different companies across various industries. You don't want to have all your money in just one type of investment, like stocks or real estate, as this could expose you to greater risk. Focus on long-term investment. It's generally better to focus on long-term results rather than short-term gains. While it may be tempting to invest in what performed best last year, past performance is not always a good indicator of future results. Looking at long-term averages, U.S. stocks have performed well over time, with the S&P 500 index growing significantly over the past century. Index funds for most investors. Index funds, which track a market index like the S&P 500, offer a simple and effective way to diversify your portfolio. They are low cost and provide broad exposure to the market. Even famous investors like Warren Buffett recommend index funds for most people because they tend to perform well over time and require less effort and expertise than picking individual stocks. Know what you own. If you choose to invest in individual stocks, make sure you understand the companies you are investing in. This means knowing what they do, their business model, and their growth prospects. Don't just buy stocks based on tips or recent trends, as this can often lead to poor investment decisions. Balancing simplicity and risk. If you prefer simplicity, consider investing in a single index fund regularly, like once a month. If you enjoy taking a bit more risk, you can allocate a smaller portion of your investment money to pick individual stocks. The key is to find a balance that suits your personal preferences and risk tolerance. Stay informed and be careful. While investing can be rewarding, it's essential to stay diversified and be cautious. Understand your investments and keep things as simple as possible to avoid unnecessary risks. Bottom line, diversify your investments, focus on the long term, and consider index funds for broad market exposure. If you decide to pick individual stocks, do thorough research and understand the risks. Have you learned anything so far? If yes, just type, "I am happy to learn about investing as a beginner." Also, ask me any questions in the comments below, and I will try my best to answer them. Make sure to hit the like button and subscribe for more valuable content. Do share with your friends if you find this video valuable. Chapter 5. How much money should you invest? You should invest money that you're comfortable not needing or touching for many years. Investing should not involve money that you might need in an emergency. You don't need to be wealthy to start investing. Even small amounts, invested consistently over time, can grow significantly thanks to compound interest. For example, investing $200 a month for 20 years with an average 10% return could grow to over $214,000, more than doubling your initial contributions. Build good habits by treating investing like an essential bill that you pay each month. You don't need to invest the same amount each time, but regular contributions will help. Increase your investment contributions when you get a raise or a bonus. The earlier you start investing, the better, as this allows your money more time to grow. The best time to start investing is always now, especially if you're a long-term investor using index funds. Trying to time the market, buying low and selling high, is risky and often leads to more losses than gains. Studies show that spending time in the market is more valuable than attempting to time the market. Consistent, long-term investment generally leads to better outcomes than frequent buying and selling. Starting early is advantageous, but it's never too late to start investing. Time is an investor's best friend, as compound interest works better over longer periods. Trying to predict market highs and lows is difficult, even for professionals, and can lead to higher costs due to trading fees, taxes, and mental stress. Most successful investors recommend focusing on the long term rather than trying to guess short-term market movements. Use index funds to simplify investing and reduce risk. Avoid trying to time the market and instead focus on staying invested for the long haul. Bottom line, start investing as soon as you can with money you don't need in the short term. Focus on regular contributions, use index funds, and aim for the long term to maximize your investment growth. Chapter 6. Can you lose money investing? Yes, you can lose money. Investing always carries some risk. You can lose money, especially during certain periods. However, you only realize a gain or a loss when you actually sell your investment. Market fluctuations are normal, so the value of your investments may go up or down. It's important to stay calm and not panic sell during downturns. The level of risk you take is personal and varies from investor to investor. Generally, higher risk can mean higher potential rewards, but this is not guaranteed. If you are losing sleep over your investments, it could be a sign that you are taking on too much risk. Understand what you're investing in and choose a level of risk that you're comfortable with. Diversification is key to reducing risk. By spreading your investments across many companies or using index funds, you protect yourself from the failure of a single investment. If you're heavily invested in a single company or sector, you could lose everything if it fails. Index funds, which track a wide range of companies, are a safer choice for most investors. Be cautious with high-risk investments like options, leverage, cryptocurrencies, or trading forex. These strategies can lead to significant losses and are best avoided by new investors. There are no shortcuts to making money with investing. Beware of anyone who promises quick and easy gains. Chapter 7. What are the preparations to be made financially before investing? Before investing, ensure you have an emergency fund covering 3 to 6 months of living expenses. This fund provides a financial safety net, so you don't have to dip into your investments during unexpected situations like job loss or medical emergencies. Prioritize paying off high-interest debt, such as credit card debt, before investing. High-interest debt can erode your financial gains faster than most investments can grow. Establish why you're investing in the first place. Having a goal will help you stay motivated during tough times when the market is down. Whether your goal is buying a house, retiring early, or saving for a specific purchase, a clear objective will keep you focused and less likely to abandon your plan. Understand your comfort level with risk. Different investments come with varying levels of risk, so it's essential to align your investment choices with your risk appetite and financial goals. Review your monthly income, expenses, and savings to identify how much money you can allocate toward investing. Ensure your budget accounts for regular contributions to your investments while covering essential expenses and savings goals. Educate yourself on different types of investments, such as stocks, bonds, mutual funds, ETFs, and real estate. Knowing the basics will help you make informed decisions and choose investments that align with your goals. Make sure you have adequate health, life, and disability insurance. This protects your finances from unexpected events that could derail your investment plans. Consider starting with a small amount and gradually increasing your investment. Diversify your portfolio across different asset classes to spread risk and increase potential returns. Only invest money that you can afford to leave untouched for several years. If you need the money in the short term, investing is not the best option due to market volatility. Interrupting the power of compound interest by frequently buying and selling can diminish your returns significantly. By preparing financially before investing, you can build a solid foundation that maximizes your chances of achieving long-term financial success. Bottom line, investing involves risk, and it's important to understand and accept that risk to grow your wealth. By diversifying your investments, preparing financially, and having a clear long-term plan, you can navigate these risks effectively. Do you have any questions so far? Do ask me any questions in the comments section below. Chapter 8: How to invest and what platforms to use. To start investing, you need a broker or an investing platform, much like choosing a supermarket for groceries. Many years ago, you had to call a broker to make trades, but now you can use online platforms or apps. The right platform for you will depend on your needs. Some platforms offer a wide range of services, but may charge higher fees, while others focus on low costs with fewer features. Always choose a regulated and protected platform. For U.S. investors, look for brokers who are members of the Securities Investor Protection Corporation, SIPC, which protects investments up to $500,000. Also, check for FDIC insurance if applicable. Compare platform fees, which can be charged as a monthly rate or a percentage of your investment. Look for trading fees or commissions, which can apply every time you buy or sell. Some platforms offer commission-free trades. Understand how these companies make money, such as through foreign exchange fees when buying international stocks. Consider tax-advantaged accounts like retirement accounts, 401k, IRA, or regular brokerage accounts. Look for platforms that offer features you need, such as fractional shares or a broad selection of ETFs. You can have multiple accounts on different platforms, each offering various benefits and features. This strategy can help you diversify your investment options. Individual retirement accounts, IRAs, are tax-advantaged accounts for retirement savings. There are different types, such as traditional and Roth IRAs. Employer-sponsored retirement accounts like 401k offer tax benefits. Regular investing accounts without specific tax advantages, suitable for flexible investment goals, are called taxable brokerage accounts. Look for platforms with low fees that meet your needs. For example, if you plan to invest in a single index fund monthly, ensure there are no fees for this type of transaction. Check whether the platform allows investing in U.S. stocks, ETFs, fractional shares, etc. Some platforms offer sign-up bonuses or free stocks. Keep an eye out for these offers, but remember that they can change quickly. Choose the right type of account based on your goals, such as retirement, education savings, or general investing. By following the above steps, you'll be well prepared to choose the right platform and start your investing journey. If you're overwhelmed, don't worry, sir. There are many resources available to help guide you through the process. You've made great progress by diving into this video, and you now have a solid foundation on investing. While there's still a lot to learn, don't worry. I've got you covered with plenty of additional resources. Check out the playlist on my channel for more beginner investing tips and details. If you're ready to take the next step and explore some top index funds, don't miss my popular video on that topic. It's a fantastic way to start building your investment portfolio. Feel free to ask any questions in the comments below. And before you go, make sure to hit the like button and subscribe for more valuable content. Here's to your investing journey. Let's make it a successful one.